the ShadowTrader video weekly for Sunday, March 17th, 2013. Happy St. Patrick's Day. I'm here on this rainy, snowy day here in Philadelphia. I have the lovely Scarlett next to me. What are you doing? You're drawing?
I'm drawing.
What are those?
Hands.
Oh, I see. Interesting. All right. I thought they were like bunnies. They look like bunny ears. All right. Anyway, let's get to it. S&P right here in front of you. The big question on everybody's mind is obviously, is the rally over? Is it going to go a little further? I am continuing my focus to be on the trend line here, meaning the trend channel that you can see. So I think we have a little bit more to go. Every week I keep moving the channel up because, you know, obviously it just moves up by time. So I'm measuring it around 1572 now. It's amazing how it just gets higher and higher because the market just won't really quit here. So it's roughly anywhere between about 15, let's call it 1567 to 1572 or 73, right in that area. There's been a little bit of divergence recently with some of, like, for instance, I mean, the Dow just keeps going higher as well, but the NASDAQ is showing a little bit of relative weakness here. If we look at like NDX, kind of stuck in a range still on NASDAQ composite, but this is really typical that the indices would be kind of out of sync. So to me, the main thing is, even though the market is extremely overextended here, I think it has a little bit more room to go, at least just a little bit on that S&P. The other reason I think that is also given the fact that we have a prior historical close in the S&P from October 2007 at 1565.15, and we have not yet closed above that. I think it would be very strange that the market would come so close and not breach that level, right? And the other thing that I'm also noting here really closely is that I keep looking at how a lot of these sectors are acting, and for instance, transports, which have been a leader in this market, they really didn't pull back at all in Friday's action, right? Friday had a little minor pullback in the S&P. You can just kind of A/B it here and look at, this is what the SPY looked like, right, intraday here. This is actually a 24-hour chart, so it's showing all of it. And then if you look at the Tran in the index, look how it closed right back up at the high, right? And then also drugs, which is pharmaceuticals. Notice where they pushed to actually new highs while the market pulled back. All right, so in the bigger picture, this is also indicative to me that we still have just a little bit left to go, and yet that actually may be putting in a top because these types of defensive sectors tend to rally at the end. We've also been seeing deterioration recently in some of the leading sectors, or some of the more tech-related issues. I already showed you how the NDX is actually kind of lagging here, so tech is kind of lagging. All this kind of ties in to me that there's less appetite for growth and momentum type stocks, more appetite for dividend players, things like that, consumer staples, pharmaceutical, utility especially. For instance, look at UTY. Again, do you see? This doesn't look like any sign of a top yet in the utilities. So all of these things lead me to believe that the S&P could actually crawl just a little bit higher, okay? Now, given that I just said crawl, that's going to lead me into the next segment here where I talk about the profile, which is really important. The market really has done very little in terms of the upside other than just crawl. The structure here continues to be poor. What I'm seeing as far as the profile moving up over time is constant overlapping value. We had our first day of breakaway value here on Thursday, yet once value broke away from the prior 3-day balance here, it did not extend. Usually, if the market was going to be stronger, you would want to see a gap up, not only a hold, but you'd have extension to the upside where the profile would actually be longer. This profile is very, very squat. It's kind of small. It's got a compacted value area, so there's not really that much happening there in terms of new longs aggressively stepping in. The market has also been one time framing for a long time. This is an important market profile, piece of information to take away, is that one time framing is when each day's low cannot take out the prior day's low by at least 2 ticks. That has constantly happened. Friday was the first day that the market did not one time frame higher. It actually broke the one time framing phenomenon, right? Because you notice that Friday's low was more than 2 ticks below Thursday's low. However, even though that has bearish implications, I'm still more focused on the fact that over all this time, as the market has been rallying, and I'll break it out here so you see more profiles, we continue to see a lack of excess to the upside. Remember that usually these slow grinding up markets will end with a spike move up and a big reversal back down, and that'll be like your last capitulation move when it's just kind of crawl, crawl, crawl. It rarely ends with a whimper where the buyers just get tired and it rolls over. That's why I don't think that Friday's action was really all that bearish. And as I was saying, is once we do get that sort of capitulation top put in, what will happen is the profile will show excess to the upside. Remember that excess is just simply where you have a more fat tail to the distribution to the upside, very similar to the example here on this date here, where you can see the long tail to the bottom. Imagine if this single line print of TPOs was sitting here up on top of the profile. That's what we're trying to see. That's called excess. And so far, there's really been a complete lack of excess in the markets. The odds do not favor that the current up auction will end without meaningful excess. It can end with the buyers just getting tired and exhausted and just kind of rolling over, but generally it will not happen that way. So that's what I'm seeing. I'm also noting the fact that Friday, although we failed to make a higher high in the market, and we did make a lower, a new 2-day low here, meaning that we did take out the prior day's low. Notice what happened with value, and remember that you want to be able to trade value and not price. Value really didn't move much. The market was very, very comfortable with price staying between 1552 and roughly 1555 here. The point of control only migrated down a couple of handles and is here at 1553.50, well inside of the prior day's value area here on Thursday when we made the high of the move. Okay, so all of these things tied together basically, lead me to believe, like I've been saying, that market probably has a little bit more to go in it. Some of these defensive sectors look like they want to rally a little bit more, and so we shall see how this plays out. The other thing also, coming into 2 weeks left into March, I want everybody to be very aware, and I'm going to switch back into the S&P chart for this, is the simple fact that you'll have a lot of fund managers, I think, that would like to paint the tape here and probably sell out some of their positions that they've done really well in this quarter. The market has rallied a lot in all of 2013, and you can see that you have a lot of straight up action February, very strong, or January rather, strong action reversal here in February, and then higher in March. We have to, once this level is breached in the S&P right at the top here, I'm going to start not only thinking that it's a technical resistance and I would like to initiate shorts, but also be thinking to myself that people who have been long this market and need to put good performance on the board for the first quarter, they will be looking to get out of their positions probably, I'm thinking, before the quarter is over. So at some point in these next 2 weeks, I believe that could be a catalyst to kind of turn this market around and take things back a bit. And if there is to be a retracement, I would be thinking probably some sort of a mid-channel move such as this. I'll draw a middle of the channel. And notice that a mid-channel there brings the market just back to its 20-period moving average on the daily. Also, as one last thing is, when I'm thinking of a reversal, remember I have a basic rule for the market getting too overextended from its 20-period moving average. Notice that the 20 MA right here now is at 1530. If the market was to rally to the 1570, as I was saying, that would be a 40-point differential between where price is now and the 20 MA. I've said this before many, many times. It's a very simple rule of thumb. Anything over 40 points away in the S&P from the simple 20-period moving average is usually a sign of unsustainability. The trend is too steep. It's too far away from that moving average, and you usually see somewhat of a correction, right? All right, so I think that's pretty much it for this week. Scarlett, you got anything?
You didn't talk about sugar.
Oh, you're right. Sorry about that. Hold on one second. Sugar. Yes, I'm still in the sugar trade, which has moved up a bit this week, pulled back a little bit, but I have now moved the stop. The trade is long from here, from under 18, and stop on the whole thing is now moved to the pullback low here, which I don't think should be violated. At this point, that would also put us underneath the uptrend line, and target on the first half is now just over 1920, which is just below the main downtrend line. How did you know about that, by the way?
I got your tweet.
Ah, okay, good, very good.
I've been telling all my friends at school to eat more candy.
Well, thank you very much. Hopefully that will help considerably, and we'll see if that'll get sugar prices a little bit higher.
Can I do the outro now?
You think you're going to do the outro?
Yeah.
Okay, ready? Here's Scarlett with the outro. Hit it.
On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.